You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Hi, this is Tom Cock. Welcome to Talking Real Money. We don't generally introduce our children to drugs or alcohol. We don't generally introduce them to eating disorders, overeating, undereating. We don't generally introduce them to other bad habits, but it appears that we still want to introduce them to gambling. Recent column by Chuck Jaffe, someone that we know and respect. We've talked to him before on the radio. He has a column every week that appears in the Seattle Times, and I know in other publications, and he's a podcaster, someone who's been around for a long time, and generally his advice, I think, is good. Although he tries to straddle both sides of the fence when it comes to being an active investor and a passive investor. He thinks he should own both. To me, that's being a Republican and a Democrat. We'll let that one go. Because in a recent column, now that the holidays are here, he was again talking about the idea of giving your kids, maybe your grandkids, the gift of stock or stocks, rather than having them be given things, in his words, holiday and birthday gifts, that the monetary worth of things that never wound up in a basket of old toys. Yeah, we've all been there. The pile of under and unappreciated shows of love, stuff that broke, played out on its way to the town dump. I get it. Things that might not have been central to their lives. Young people may have used for a very short period of time. I'm on board. I think in the holidays there's overconsumption just for the sake of overconsumption. I don't like it. We've worked hard in our family to try to only give meaningful gifts and fewer of those over time. But, so we're in agreement with Chuck generally. Better to give people something that's lasting. But the details, this is the struggle. Because he says today, and he's correct, it's never been easier to buy individual stocks. You can buy stocks by the slice from Fidelity, stock slices from Charles Schwab, fractional shares on an app like Robinhood. And then he compares it to the 1990s when his kids grew up and how difficult it was to buy individual stocks. By the way, it appears it was relatively successful. The money that he invested for his children, both of them are over 20 years old and each have about 20,000 or more in their accounts. I think that's marvelous. The struggle I have with this advice is, again, it's suggesting that the best gift to give is individual stocks. He says mutual funds were a gifting option. I'm quoting now. They sold fractional shares, so buying round dollar purchases was easy, but, and here's the quote, never offered the lessons that stocks do about ownership, about controlling assets you believe are valuable, and more. A kid can understand that they like McDonald's and they want to own it. They don't get any sensory learning from owning the XYZ fund. In other words, it's not very sexy, it's not very interesting, and there's not a lesson to be learned there. I'm going to argue with him here that he's wrong. That again, if you're going to give your child a gift of stock, let's get the lesson right from the beginning. We know that even the experts don't pick the right stocks. And by the way, going to McDonald's or Starbucks or using Zoom is not a reason to invest in shares of that firm. That's a completely misleading reason. Look at the early 2000s. People put millions of dollars in tech companies because they were going to pets.com. How did that turn out? So the fact that you shop somewhere, and I know Motley Fool espoused this as well, is not a reason to own that company. And by the way, it gives you no insight as to how the company's operating. Absolutely none. So that is really a misnomer. Number two, you're taking a ton of risk that young people have no idea. That by placing a lot of their money in an individual equity, especially one if you buy it in your early years, 5 to 10, the longer you hold that, the greater risk the stock has of going out of business because firms do go out of business. Number three, you can now and I'm going to steal this quote from my friend Don McDonald, you can now give your child for less than $100 the world. What am I talking about? You can buy one share of VT, that's Vanguard's Total World Stock Index Exchange Traded Fund, VT, for in the 80s. It was about $83 when I looked it up. So again, perfect gift for a child and a perfect way. Yeah, here's the exciting thing. You now are a player in the global economy. You're not trying to pick Boeing or Starbucks or Microsoft. Nobody has any idea what those things are going to do, but over the long haul, the global economy has gone up. So I think you're teaching them the right lesson from the beginning rather than when they do get in their 20s and 30s trying to reteach them that owning individual stocks was a bad idea. Chuck says you'll teach your investment lessons to your kids. You'll be solving some of the learning challenges and your holiday shopping dilemma all in one swoop. In this case, no, I think you're wrong, Chuck. We should be teaching them that buying a globally diversified portfolio and using the returns of all of those great firms. I still think this is one of the great things you get to do. You get to put your money in, expose it to terrific companies that over time have created great wealth. I think it's absolutely wonderful. Before I go, I want to mention one call I got Saturday after our live show, which, as you know, airs from noon to 2 Pacific Standard Time. This from an 85-year-old listener. Says she listens to every single show. So bless you for that. I really do appreciate it. I'm not going to mention her name here. But she said, I heard on the show that you'll give an hour of time to anyone to help look at their situation and get it right. I said, absolutely. What is your question? Well, it turns out that most of her money is in 3 Vanguard bond funds, very low cost. One's the Ginnie Mae fund, so it has a little bit of yield there, a little over 2. The other 2, the yield is very, very low. And then she also has some money in the Vanguard Wellington Fund. And she said, well, with what's going on in the world and now the election's behind us, it appears we have a vaccine. Things are going to get back to normal. I was thinking I'd take a bunch of my money and put it in stocks because I'm really not making much in bonds. We talked through about how much money she needs from those bonds. It's a little, what she needs to take out of it is a little bit more than just interest, right? She's going to have to live off some of the principal, which I explained to her is fine because she's 85. Take some of the principal out. Don't take risk of putting money in stocks and hoping they're going to go up for this next short period of time and provide greater growth. You have no idea. And here's the other part to remember that I tried to impress on her. Inflation is low too. Interest rates are low, but the cost of living is not going up much either. So that's my advice to any of you. If you have money in bonds, and that's there because you're risk averse, as she is, by the way, you should not be rushing it into stocks just because they've gone up lately and because they could provide greater lift in the near or long future. We don't know anything about the near future. In the long haul, yeah, we believe stocks will make more than bonds, but there have been periods where it has not. So don't run off and do that. Thank you, by the way, for listening. That's so very, very kind of you. And for any of you listening, we are glad, yes, to give you an hour of our time, any of our advisors, to look at your situation, figure out retirement, and help give you a second opinion on anything you're thinking of doing or already invested in so you get all of this straight. Thanks for joining us here on Talking Real Money. I'm Tom Cock.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.